Okay, so you attempted to place a limit order on one of your exchanges, but somehow that order didn't get filled or was canceled before you had a chance to execute it at the price you set. Why does this happen? Well, there's a couple of reasons to it, and we're going to talk about it here on the Ujamaa Network. I'm Antoine Anderson. Let's get to it. I've been getting a lot of good feedback recently on the channel, and one of the questions that came up today got me to thinking. Well, actually, it was a couple of days ago, and it was basically a situational question about the trigger of a limit order, what happens with it, or when you should set it. Now, we don't do any strategic advising on this thing, but this again was a hypothetical question. It was a very good one. Now, I got the cow by the tail and didn't really grasp the meaning at first because I'm not a professional trader, but it got me to thinking once he replied, and it was very poignant because it got me to thinking about what happens when your limit order isn't filled or gets canceled halfway through. It's a partial order. Well, there are some factors that you need to be aware of that causes this, and we're going to talk about them as it relates to a few of the different exchanges out there. But the main thing run revolves around some individual system rules that's going on the different exchanges, market volatility, and the last thing is liquidity, meaning that there's just not enough crypto available to fill these orders that are coming in. We're going to get into some very intense topics on crypto trading, and this, I hope, will open the eyes of many people who have been on the fence about crypto. Let's talk about it. Now, one of the first barriers to limit orders are things that the exchange itself will impose on all of its users. Rules and limits and fees that are set prior to making the purchase or the attempted purchase when you're interacting with that exchange. Now, it's usually varies between the different exchanges, but in our example, we're going to be looking at Uphold, and there is a weekly, daily, and monthly limit that you can actually trade in amounts on that exchange. Now, if you exceed that amount, well, that trade is not going to process. There's some other issues that concern how much actual funds you have in your source account to buy it from. If you have any shortfalls there, then that will cause the order not to execute or not to be processed because you didn't have any money to trade that day. Keep in mind that Uphold has a limit on orders under a certain amount of dollars. For instance, I think it's under $100. Anything under $100, you're going to pay $1 to actually process any transaction. Above that, there's no fee. Just got to keep that kind of stuff in mind when you're dealing with this particular exchange. And we'll get into the other two reasons with other two exchanges. Now, with this next example, I'm going to point directly to Robinhood because this one was an extreme example of what could go wrong when an exchange doesn't quite act in accordance to what has happened. Of course, I'm alluding to the big Robinhood shutdown that happened years ago that led to a congressional action or congressional hearings on how these trades were being handled. What happened in this particular instance, there was some market volatility. There was a bunch of hedge funds involved in basically betting against AMC and GameStop that day. And what ended up happening is that a lot of people stood to make a lot of money, but because the Reddit community that got involved, it had actually pushed the market in a different direction than what the hedge fund holders were betting on. That led to a massive halting of people trying to sell at a particular time. Now, that one was deliberately done. It wasn't like what we hear with unstable market conditions alone. The system literally prevented individuals from selling their crypto. People lost tons of money on that, and I don't think that we really ever got a good clarified answer of why that happened or why it won't happen again. But it was one of those instances that really gave people pause because it seemed like the deck was rigged against the small time investor. It was one of the reasons why you could kind of tell that there was just something else happening out undercurrent of people just fed up with traditional uh, transactions in major hedge funds and the stock market, and wanted a different way to earn money off of something that nobody really had an advantage on, and that would be crypto. And this was one of the big reasons why an order may not be filled, because somebody may just be putting their thumb on the scale, so to speak, or there could be some kind of system crash, and that's the second reason of why your limit order may fail. Now, our final example, we're going to be talking about Gemini's answer, the exchange Gemini, on market liquidity. Basically, when there's just too many orders and not enough crypto to go around, liquidity shortfalls happen when there are just so much hype in the market. People are trying to buy it, trying to get on the next bull run, but there's just a limited number of cryptocurrencies being released. Now, you can see the open ledger, and we're talking about ledgers for things like Bitcoin, Ethereum, and XRP. It's an open ledger. And one of the big strengths about cryptocurrency is that everybody can look at each transaction as they are going through by going to one of three sites. You have XRP scan for XRP, you have Bitcoin or blockchain.com for Bitcoin, Etherscan for Ethereum. The way these transactions are recorded are via a hash rate. Ethereum has an exception where they actually also show you what the gas fees are to prevent some of the transactions from failing, or to put a kind of a hierarchy on those transactions. You can pay a premium to have the transaction handled at a faster rate versus somebody who's paying a lower fee. One of my biggest gripes about the Ethereum method of payment is those gas fees, whereas XRP, the fees for those transactions are well under a penny, and they are the fastest there are amongst all blockchains. So it is something that everyone kind of needs to get a hold on as to why this technology needs to be pushed, because you're talking about faster settlement times for transactions and this added security of having multiple computer systems working simultaneously in a secure manner to validate those transactions in an electronic ledger. It is that concept that leads me to believe that their future is still bright with crypto. Let me know what you think in the comment section below. I like to add as much as I want to. Like, subscribe, join, and I will talk to you very, very soon.